Welcome to Breaking News to Trading Moves. We're here to help you move from the latest market headline to a detailed look at the retail sector dynamics that follow.
That's right. Our goal is to take a single event, a campaign win for American Eagle, and trace the chain reaction across the marketplace.
And for you, the listener, this analysis is a way to get a quick but thorough read on current consumer behavior in apparel. We want to see which competitors gained and which faced immediate pressure.
Exactly. It's about seeing where the spending is really concentrating right now.
So the headline that got this whole conversation started is all about American Eagle Outfitters. Their stock, that's ticker AEO, saw a noticeable jump after its recent denim campaign proved to be a big success.
And that one piece of company news became a real data point for the entire sector.
Cool.
The performance of American Eagle is important here because it's not just some isolated corporate win.
It's more of an indicator.
It's a powerful, real-time indicator for analysts. It shows very clearly where consumer money is flowing in the apparel market, which can be pretty volatile. And crucially, it showed that a very specific, very desirable group of consumers was willing to pay full price.
As long as the brand and the marketing were on point.
That's the key, as long as the execution was spot on.
All right, let's start by dissecting that core event. The circumstances that led to the rise in American Eagle Outfitters stock. This wasn't just, a simple clothing promotion.
No, it was a highly targeted, celebrity-driven effort built around their core product, denim. The success is tied directly and very explicitly to their Great Jeans campaign featuring actress Sydney Sweeney.
And in the world of retail advertising, which is just incredibly crowded, just getting attention is a major part of the challenge, isn't it?
It's more than half the battle, and this campaign really managed to cut through all that noise. But what makes this story so potent for the market is that the result wasn't just social media buzz or high click-through rates.
It was more than that.
It translated directly into tangible financial results.
And when we say tangible results, the key metric analysts were watching was the strong return of in-store traffic. Right.
Exactly. People weren't just looking at the products online. They were actually showing up at the brick-and-mortar stores with a clear plan to buy something.
And that robust performance let the retailer do something that's pretty rare, but essential in the eyes of the market.
They raised their holiday sales outlook.
Which is always a strong signal.
Oh, absolutely. Raising guidance tells shareholders that the current path for sales and profits is stronger than the company had previously forecast. It's a real sign of confidence. But the absolutely critical piece of context here, the detail that really frames the entire reaction we're about to talk about, is this.
Okay.
The success was specifically credited to spending from more affluent shoppers as we moved into the holiday season.
That detail about the affluent shopper, that's the linchpin. That really changes the story.
It does. It suggests that discretionary spending is still remarkably robust at the higher end of the consumer income ladder, even while other parts of the retail market might be struggling with inflation or economic jitters.
So it confirms that targeted marketing, especially when it's done perfectly with a celebrity who connects with the target audience, can be incredibly effective at driving immediate high-margin sales.
That's it. The AEO campaign used high-profile talent and focused on denim, which is a fashion staple for almost everyone. That made its success an immediate blueprint for the whole apparel sector.
So if you're analyzing this sector, AEO's execution is now the standard you measure against.
For the near term, absolutely. Other similar brands are immediately measured against American Eagle's ability to generate that kind of foot traffic, and most importantly, capture that full-price spending momentum. It shows consumers will pay up if the brand feels current and desirable.
So if we look at the mechanics, AEO showed pricing power, the ability to sell things without huge discounts because they created a sense of desirability.
Right. Which is a very different model than just relying on constant promotions and sales.
Of course.
Pricing power is gold in retail. When a company announces better than expected sales, and it can tie those sales to full price purchases from a financially resilient group of consumers, that points to margin expansion.
It signals that they're operating better than their rivals, who might be stuck with too much inventory or just relying on markdowns to move products.
Exactly. This AEO triumph wasn't about selling cheap jeans. It was about selling desirable jeans to people who aren't that price sensitive right now.
Okay, so now that we've got the catalyst clear, let's pivot to the winners. Based on American Eagle Outfitters' strong performance and that data point about affluent shopper spending, the market quickly pinpointed 3 different categories of companies that would likely benefit.
These are the stocks that got a bit of a positive updraft.
And the logic here is basically predictive trading, right?
It is. These companies either operate right in the same niche that AEO just proved was successful, or they profit indirectly from what's expected to be an increase in competitive ad spending across the retail world. It's a calculated bet on spillover success.
Let's start with the first group, which is the most obvious one, direct peers. We're talking about teen and denim-focused apparel brands.
Right. The core idea for the market here is that American Eagle Outfitters' performance validates the entire business model for this specific niche. It suggests a rising tide will lift other similar boats.
And what American Eagle Outfitters, again, ticker AEO, did was offer clear proof of concept for the whole sector.
Precisely. They showed that targeted marketing focused on a core product denim can reliably lead to higher traffic and stronger comparable sales.
Okay, wait, let's slow down there for a moment and define that for anyone listening who might not track retail metrics every single day. When you say comparable sales or comps, what are we measuring and why is that so important here?
That's essential context, yeah. Comps, or comparable sales, track the sales from stores that have been open for at least a year. It's seen as the purest measure of a retailer's underlying health because it filters out the noise from, new store openings.
So it's an apples-to-apples comparison.
Exactly. If AEO reports strong comps, it means their existing marketing and product strategy is working where they already operate. So when the market sees AEO achieve this with a targeted campaign, it makes traders think that similar campaigns from similar companies will also boost their comp numbers.
So if AEO is the gold standard for comp growth fueled by this desirability factor, who is the main peer the market immediately looked at to follow suit?
The primary peer identified here is Abercrombie and Fitch, ticker ANF. They are seen as the company most likely to benefit from the general optimism in the specialty teen apparel sector.
And Abercrombie and Fitch has made some substantial efforts in recent years to modernize its brand, right? They've moved away from that older, heavily logo-focused style.
They really have. They've shifted to a more sophisticated, trend-aware offering. And that rebranding effort is critical. It suggests that ANF is structurally aligned to catch the same consumer momentum AEO generated.
So if the consumer is willing to spend full price on fashionable, youth-oriented labels, ANF is positioned to capture that renewed attention right alongside AEO.
Absolutely. The success of AEO gives a general lift, showing that the core youth demographic is receptive to refreshed, full-price specialty labels. The market reads AEO's success as validation that the consumer is prioritizing brand and style over just getting a discount.
Which is a narrative that strongly supports ANF's recent strategy as well.
It fits perfectly.
Okay, so moving beyond just the denim niche, the market also expanded the winners list to include youth-oriented specialty retailers in general.
Yet the thinking here is that AEO's results prove that the fashion-focused younger consumer still has and is willing to use their purchasing power.
That's the key takeaway. Purchasing power, but with discretion.
Exactly. The market doesn't believe consumers are pulling back entirely, as long as the brand generates enough social media buzz and maintains a relevant fashion message. When one prominent brand succeeds, it gives confidence that this key demographic will still spend, especially on specialty labels known for being fashion-forward and socially relevant.
They're choosing where they spend carefully, but they are still spending on items that, help define their identity.
Right. And this brings us to a name like Urban Outfitters, ticker URBN.
URBN.
Urban Outfitters is a classic example of a specialty retailer catering to that younger, fashion-conscious consumer. They often focus on lifestyle and unique trends outside of pure athletic wear or basic apparel.
And like AEO, their success really depends on identifying and marketing trends effectively, generating that must-have feeling.
It does. So the positive outcome for American Eagle Outfitters strengthens the broader investment narrative around all companies that successfully serve this same discerning demographic.
Okay, and then we get to a name that feels a little bit outside the box. Lululemon Athletica, ticker LULU. Now, Lululemon isn't known for denim or fast fashion. They are all about premium athletic and leisure wear. So why does AEO's denim win help Lululemon? The connection seems a bit loose.
It's a correlation based entirely on consumer quality, not on the product category itself.
Okay, explain that.
Lululemon Athletica, LULU, benefits from the sentiment that the high-value, youth-oriented shopper is spending freely. While they operate in a different product vertical, Lululemon targets a premium, fashion-conscious consumer who values brand status and social relevance, often the most affluent part of that youth market.
Ah, I see. So it's validation for the premium price point in the youth market. If American Eagle Outfitters can sell full-price jeans because their campaign created a buzz, it proves that the consumer Lululemon targets, the one willing to spend $120 on leggings, is still active and healthy.
Precisely. If the market sees concrete evidence that the young, discerning, and generally affluent shopper is still opening their wallet for specialty, full-price apparel, Lululemon's stock often benefits. Its business model is built on attracting and retaining that exact same type of high-value, brand-loyal consumer.
So it's not about the jeans, it's about the jean buyer.
Exactly. It validates the broader financial health and spending habits of their core demographic, even if the product itself is different.
Okay, so the category of winners moves completely away from apparel. It focuses on the underlying machinery of retail competition, advertising and marketing holding companies.
Yeah, this is a great example of how success in one area immediately forecasts spending in another. The insight here is pretty simple. AEO's successful campaign signals an immediate acceleration in competitive spending across the entire retail industry.
And this connection is based on the reactive nature of retail, right?
It is. When one competitor, in this case, American Eagle Outfitters, explicitly finds success by leaning into advertising, as their management said, it sends an urgent message to every other retailer in the space.
And that message is, you have to spend aggressively too, or you risk falling behind.
You've got it. So if Abercrombie, Gap, and Levi's all decide that they need to launch their own high-profile, expensive campaigns with celebrities or viral content to stop AEO from gaining too much market share.
They dramatically increase the overall advertising budget for the whole sector.
That's exactly right. This competitive acceleration drives revenue directly to the major players that execute these campaigns. All the preparation, the creative development, the media buying, placing ads across digital and traditional channels, all of that requires substantial resources.
And who are the main companies that receive that suddenly larger budget?
The names here are Omnicom Group, ticker OMC, and Interpublic Group, ticker IPG.
OMC and IPG.
Yeah. And these are not small marketing firms. They're global holding companies that house massive networks of advertising, media, and PR agencies. So when major retailers in the apparel sector decide they need a multi-million-dollar ad blitz to keep pace, those budgets flow directly into the revenue streams of OMC and IPG.
So we're looking at two major levers here. First, the AEO success confirms that targeted, expensive advertising actually works, which encourages others to do the same.
Right. And second, the competitive environment dictates that if you don't keep up with AEO's ad spend, you effectively give up market share.
It's a powerful dynamic.
It really is. When the retail wars heat up and budgets swell for things like celebrity endorsements, viral content, and mass media buys, these holding companies see a direct and predictable uplift in their billing and, in turn, their market valuation.
So the market sees AEO's success as a guarantee of future high-margin spending by its competitors, benefiting the entire advertising infrastructure.
It's almost a guarantee of revenue for the agencies, no matter which retailer ultimately wins the sales battle, because everyone is forced to increase their marketing expenses.
That's a great position to be in.
It creates a non-cyclical element of growth for them. Even if the consumer market tightens a bit, the competitive spending between retailers often accelerates because they're fighting harder for every single customer. And OMC and IPG capture that accelerated cost of competition.
So we've outlined the companies that benefited from the market enthusiasm that American Eagle Outfitters generated, which was all fueled by that high-spending consumer. But in retail, sales volume is finite, and success for one brand always means more pressure for others fighting for the same wallet share.
That's right. So we have to transition now to the companies that immediately faced market challenges as a result of this.
Okay, so let's get into the losers.
The success of AEO's focused, full-price strategy creates difficulties for three specific groups: legacy competitors in the same product category, general department stores that rely on traffic, and value-focused retailers who rely on a financially struggling consumer base.
And the common thread for all of them is margin pressure.
It all comes down to margin pressure. These companies either have to chase the trend through increased costs, or they have to resort to deeper discounting, which directly compresses their profitability.
Let's start with that first group facing direct pressure. The legacy denim and casual brands that lack that specific current it factor that American Eagle Outfitters managed to capture.
The core insight is pretty straightforward. Losing the market's attention directly hurts rivals who rely on the same basic product jeans. When one company successfully captures the market and becomes the current desirable jeans brand, it instantly marginalizes competitors who are selling essentially the same thing.
And these rivals who might rely on decades of brand recognition They have to react quickly, but their options are all costly.
They are. Let's analyze that cost dilemma. They have two pretty painful choices.
What are they?
The first choice is to immediately commit to much higher advertising expenses. Maybe they even try to poach a competing celebrity or launch a major rebrand in a desperate attempt to create their own buzz to compete with AEO.
And the second choice.
The second, and often the default, is to resort to heavier discounting, to simply move inventory that is now seen as less fashionable or less relevant compared to AEO's new line.
And both of those reactions, much higher ad spend or much heavier markdowns, immediately applied downward pressure on their operating margins. That makes their business less profitable in the short term, even if their sales volume stays steady.
Exactly. The names here are Levi Strauss, ticker LEVI, and Gap Inc., ticker GPS.
Levi's and Gap, two huge legacy brands.
Huge. And while these companies have tremendous brand history and global reach, if they lack that contemporary viral hook, that sense of immediate social relevance, they face difficulties. They're trying to sell a $70 or $80 pair of jeans against a suddenly hyper-relevant American Eagle Outfitters brand.
So it forces them into a defensive position where they have to sacrifice profitability, either for volume or to desperately try and regain consumer relevance.
That's right. The market saw AEO's success and immediately priced in margin erosion for LEVI and GPS.
It's like a brand perception tax, isn't it? AEO successfully convinced the affluent consumer that their jeans were worth full price right now. Legacy brands now have to overcome that perception gap, which is both expensive and time-consuming.
Precisely. They have the logistics in the stores, but AEO proved they had the superior brand resonance in this current moment. And you can't fix a brand relevance problem overnight without burning cash on marketing or deep, painful discounts.
Okay, next we look at department stores that rely on broad, mid-market apparel. Here, the core insight is pretty devastating for these traditional anchors. The success of specialty retail means that the desirable shopping traffic just bypasses the general retailer altogether.
This is all about the changing dynamics of destination shopping. The key demographic, the teens and young adults that AEO targeted, are showing that when they want denim or casual wear, they're going directly to a specialty standalone brand like American Eagle Outfitters.
They're doing destination shopping for a specific desirable item.
Exactly. They are not just walking into the mall, browsing the general apparel floor or department store and hoping to find a satisfactory pair of jeans.
So this diversion of shoppers who are specifically going to the AEO store instead of the central mall entrance results in weaker overall foot traffic within the department stores themselves.
That is the core issue. If fewer high-intent consumers are entering Macy's, ticker M, or Kohl's, ticker KSSS, the inventory they have on the shelves, which includes denim, but also other casual apparel, it just doesn't move as quickly.
And critically, the traffic they lose is often the most valuable traffic, the full price, intent-to-buy specialty customer.
That's the one. And this slow movement of inventory creates an immediate need for these general retailers to implement deeper and more frequent markdowns simply to clear out the old stuff and make room for the next season's goods.
So the lack of that desirable destination traffic leads directly to the same margin pressure we saw for the legacy denim brands, but it's driven by a failure to capture high-conversion foot traffic.
Correct. AEO's success confirmed that the energy and the spending intent are currently concentrated in focused specialty stores, leaving department stores with a higher percentage of lower intent, discount-seeking browsers.
This final category of pressure is maybe the most telling reflection of the current economic landscape. Value retailers tied to more financially stretched shoppers.
Yes. The market reads AEO's success not just as a retail win, but as a clear data point showing a widening split in the American consumer market. This is the macroeconomic angle.
Right. As we established, American Eagle Outfitters' success was explicitly supported by a pivot toward, and a lot of spending from, more affluent buyers who are willing to pay full price for a fashionable item.
And that data point is a stark illustration of a growing divergence. We're observing two fundamentally different consumer realities operating in parallel.
So you have the affluent consumers who still have plenty of discretionary funds for full price, fashion-forward apparel, the AEO customers. And then you have another much larger group of consumers who are actively trading down or cutting back entirely to save money on necessities because their budgets are squeezed by inflation.
That's where the pressure lands. Retailers such as Dollar General, ticker DG, and Ross Stores, ticker ROST, cater overwhelmingly to consumers whose budgets are under intense strain.
So when the market sees a retailer like American Eagle Outfitters succeeding by relying on the resilience of the affluent consumer,
It forces analysts to question the financial health and immediate purchasing power of the consumer at the lower end of the income scale.
in essence, AEO's success confirmed that the consumer with discretionary spending power is healthy, which inadvertently highlights that the consumer who relies on value retailers is likely struggling, or at the very least, prioritizing savings and necessities like groceries and rent over discretionary apparel purchases.
Precisely. The success of AEO unintentionally highlights the weakness or vulnerability of the customer base that value retailers rely on. These value-conscious customers are delaying purchases, seeking even deeper discounts than usual, or simply shifting their spending away from non-essentials.
Which means DG and ROST are struggling to maintain margins or grow comp sales, not because of brand relevance, but because of pervasive economic pressure on their specific customer base.
It's a crucial distinction. The market is not penalizing Dollar General for poor marketing. It's recognizing that the data point provided by AEO confirms that the consumer segment DEE targets is experiencing sustained economic distress, and that leads to reduced volume and higher pressure on profitability for those value retailers.
It really shows how one piece of news about a specific product in one segment can function as a thermometer for the entire spending spectrum. If the rich are spending and the value retailers are struggling, that tells you a lot about the uneven distribution of economic pain right now.
It absolutely does.
This analysis provides a remarkable map of the modern retail ecosystem, all triggered by a single marketing success story. The American Eagle Outfitters campaign clearly demonstrates the current power of highly focused specialty retail marketing.
And it underscores the willingness of affluent shoppers to spend when they're motivated by the right campaign. That distinction drew a clear line between the companies that benefited and those that faced immediate pressure.
We saw American Eagle Outfitters, ticker AEO, and its direct peer Abercrombie and Fitch, ticker ANF, benefit from the direct validation of the denim specialty segment.
And then youth-focused companies like Urban Outfitters, URBN, and Lululemon Athletica LULU gained from the positive sentiment about the continuing health of the high-spending, fashion-conscious consumer.
And the advertising giants Omnicom Group, OMC, and Interpublic Group, IPG, won because of the market's expectation of increased competitive spending across the entire retail landscape.
On the other side, the pressure fell squarely on legacy brands Levi Strauss, LEVI, and Gap Inc., GPS, due to margin compression caused by competing with AEO's full-price success.
And on department stores Macy's, M and Kohl's, KSS, due to lost foot traffic.
And finally, value retailers, Dollar General, DG, and Ross stores, ROST, due to the recognized strain on their core customer base, highlighting that growing spending divergence.
So the primary lesson here really emphasizes the power of brand focus and executing targeted marketing effectively over just relying on general retail traffic or broad market appeal.
It does, and this raises a pressing challenge for those legacy apparel brands. Given AEO's success blueprint, how quickly and effectively can they reallocate their marketing spend and redefine their brand identity to capture that same specific, full price-paying consumer group? That ability to pivot rapidly will determine their near-term future.
And before we sign off, we must state clearly that the content discussed here is purely the opinion of the author and is not financial advice or a recommendation to buy or sell any security.
That's right. This has been a detailed discussion about market mechanics and consumer trends, not an endorsement of any investment strategy.
Thank you for joining us on Breaking News to Trading Moves. We hope this analysis helps you track the dynamics between headline news and market opportunities. We'll be back soon with another detailed breakdown.